Good morning, ladies and gentlemen, and welcome to the show. Glad to have you guys here on this Monday, the 18th of January, 2021. Evidently, Wednesday is the inauguration in Washington. They got like 25,000 troops there. 25,000, something like that, stationed in Washington. It's really a scene that's a strange, surreal scene. But what I'm going to talk about right now is why aren't we seeing hyperinflation right now with all this money printing that's going on? How can they? An awful lot of people out there are wondering in their minds, how can they create so much money, trillions and trillions, and they make a stimulus bill, and just a month or two later, there's another one and another one, and each one's like 2.2 trillion, 1.9 trillion. How can they do all that without creating hyperinflation? Well, I'll try to explain it to you guys, and I'll try to explain why this will create hyperinflation ultimately. The main thing that puts money into the system is the fractional reserve banking system, which is different than the central banks. Right now, the central banks are in the money creation business. They're the ones producing these stimulus packages. It's the central banks. But the fractional reserve banks, when the economy's running along normally, they make money by making loans. When they loan somebody, say a guy wants to open up a new business or something, and they loan him the money, an awful lot of people picture them having the money in the vault that they loan him, that the money's already exists, and that they're giving it to him as a loan. That's not the way it works. The way it really works is they just make a ledger statement on their books. So, say the guy's name is Charlie. He comes in, he wants to open up a new fancy restaurant. He wants $1 million loan. Can I borrow $1 million to open up this new restaurant? And the bank says, yes, okay, you qualify and everything. Come on in, sign the paper and everything, sign the papers, and he signs the papers. They just go over and write $1 million in the bank's book. That's all they do. And suddenly that money springs into existence. Now, in fractional reserve banking, they used to have to hold 10% in reserve of real cash. So if you borrowed $1 million, that means the bank would have to have $100,000 of real money in the vault as a fractional reserve. But now they've lowered the fractional reserve requirement so that the bank doesn't have to have any money in the vault. They just write it down in a book, and $1 million springs into existence. But because the way the economy is, the way it is right now, they're not lending out money hardly any. What they've done is they've put their standards up so that the people that want to borrow money have to have a really good, solid... The banks, in other words, have made it tougher to get money. So they're not lending money out like they were in the old fractional reserve system. That's basically, for the most part, dried up. Unless they're going to get vast amounts of interest on their money, like credit card loans and stuff. But people can't pay all that interest, so people aren't borrowing on their credit cards. Like, in fact, they're paying their credit cards off. So all of this money creation by the fractional reserve banking system has, for the most part, dried up, or a lot dried up, right? But now we got the central banks taking up the slack, basically, so to speak, by all these new big stimulus packages and bills and stuff. So they're actually increasing the money supply. I believe it's the M2 or M1. They're increasing. Anyway, they're increasing the money supply in the system. And it's springing up, the money supply. But it's not really going at much of anywhere, except into the stock market for the most part, It's pumping up the stock market. It's pumping up bubbles within the economy. But it's in this liquidity trap where the money is not actually making its way into the system very much. But it's increasing the money supply. So the velocity of money actually goes down. And the reason why the velocity of money goes down when this happens is because they've created all this new money, but it's not moving. It's it's like a log jam. It's not getting anywhere into the system. Where when the fractional reserve banks created the money and they made the loan to the man for $1 million for his bank, the bank made him the loan for his restaurant he was going to build, right? That money gets into the system. The reason why is he goes right out with that $1 million and he starts building his building, and he hire in workers and then they get their paycheck and everything, and they go out and they buy things in the regular system. And this is how the vitality of the system starts to spring in from the regular banks in their fractional reserve lending. That makes its way into the system and increases the money supply in a different way. It just doesn't sit there, Whereas the stimulus tends to sit there and it tends to increase bank reserves. That's what it tends to do. So the banks right now, their reserves are way up. They got a lot of reserves, but they're not lending. Now, see, when the economy starts to spring back a little bit, when we start to move, this virus starts to move away, these bankers, in the fractional reserve system, will start to see opportunities to make money in the general economy by lending. And when they start to see that, that's the real one that causes the inflation, see. And now that their reserve requirements have been lowered, there's absolutely nothing stopping them anymore from lending money because they don't even need reserves on hand. They can lend as much as they want. So once those requirements are lowered, and we enter into a new phase in the system where they don't feel like the system's deflating anymore, they feel like good times are coming back again, and they start to lend out money, then we'll see the velocity of money start to shoot up. But that's the money multiplier. They can multiply that money within the fractional reserve system tremendously, very, very quickly, once the economy starts to improve and they start to relax their lending terms. And you see, that's what we got coming in 2022, and that's why we're going to see the explosion in prices. But not only that, there's another factor involved. There's all these people out there on the sidelines right now that fear deflation and have been hoarding dollars and stuff. When they start to see the velocity of money start to shoot in the opposite direction and go up, and when they start to see prices start to increase rather rapidly, they'll abandon all these ideas of deflation at that point in time. And then they'll say to themselves, hey, all this money I've been hoarding and cash, and I've been saving cash and everything, it's depreciating its purchasing power very quickly. I better get out there and spend it on something, anything of value. I better buy some gold with it, they say. Oh, I better buy some silver with it. Or I better buy some Bitcoin with it. And get it into something. And then the price starts to shoot up on these other commodities and stuff. Then it starts to swing, see? So it hasn't swung yet because we got enough deflation out there. The general economy's deflating, and the opinion of people, it hasn't swung yet. It's going to take time for us to start to move into this new paradigm and for people to start to lower their guard and the disease to start going away and the economy to start to bounce back. And you know what we're going to call it? We're going to call it the Biden bounce. It kind of sounds good. Biden bounce. The Biden bounce is coming. Probably going to start this late spring, May or June. The Biden bounce. And we're going to see it extend into the summer and fall. And that's what's going to be the trigger. Once these banks start to lend money out again, they'll see all kinds of new projects. People wanting to open new restaurants, not just restaurants, bars and grills and everything. All kinds of businesses, all these businesses that are boarded up their windows and it says for lease. There'll be plenty of places, plenty of opportunities out there. And, money will start to be lent again. And that's when we're going to see the profound inflation start. But that's also the same point in time when we're going to see the confidence lost in the purchasing power of the dollar. That's why I'm saying 2022 is going to be the big wealth transfer. I can see this ahead of time. It's coming. And not just me. I've been the first one. I was the first one to talk about this and say it's coming. For the last few months, I've been preaching it. Okay, to you guys. But now last night I was listening to Gerald Celente. He's in total agreement, and I'm going to tell you, I shouldn't give credit to myself for saying the Biden bounce. I'm going to give it credit to Gerald Celente. But by gosh, it sounds good to me, The Biden bounce, that's what's coming. And I'm in total agreement with him, and he's in total agreement with me. What I've been saying, that we're going to see this Biden bounce coming. And so we're going to have I think we're going to have a few good months. And I think next Christmas is going to be a good Christmas. But watch out for 2022, because we're going to go into the greatest depression of all time. It's going to be a hyperinflationary depression, the worst kind. A horrible depression in 2022, guys. That's when it's going to come. And people are going to, I'm telling you, it's going to be unreal. It's going to be so bad. And this is triggering it. What we've been through is triggering it. And you're going to see prices explode on things, and still no economy out there, no significant economy, because the Biden bounce isn't going to fully put people back to work again, and it's going to be a mess. Anyway, let's get the chart started right here. I know I ran over my 11 minutes and 47 seconds it took me to explain that. I only wanted to use 3 minutes. Okay, let's get the charts open right here. Take a look. Silver price today. We're looking at $24.90. It's up 11 cents. Now gold. Gold today is at $18.35. It's up $7.30 on the day. After this Biden bounce is over, that's when we're going to see the real rush into gold, silver, and cryptos. We're going to see prices explode on these things. And it's going to be unreal, for you guys. And you guys have suffered through a long time watching the price of these things be stale. Cryptocurrency today is 1,021 billion. Market industry. It's over $1 trillion. It's been hovering around that $1 trillion mark for a little while now. We're looking at a Bitcoin price of 36,307. And so Bitcoin and the cryptos are doing good. They're stabilizing in over $1 trillion for the industry. Dow Jones Industrial Average today is down 177 points. Let me refresh the page. Yes, 177 points down. We're looking at crude oil today. Looks like it's even with the board. Move index, 45.14. It's down just a little bit. Bonds and rates today. Now, here's one of the things. We're looking at the bond yields falling again, We're looking at the 10-year at 1.08, and we're looking at the U.S. 30-year at 1.83. These yields are never going to go up very significantly high because they can't let them. It's as simple as that. And if they're not doing yield curve control already, they're for the long end of the yield curve, they're going to be doing it probably before year end. It's coming. It's coming. U.S. dollar index today, 90.84, which is showing strength in the dollar. The dollar's only got its strength because they haven't lost confidence yet. Confidence is the key to all this. These are confidence markets. And so the dollar, is going to stay strong until they're absolutely sure, until it's a consensus of opinion that it's going to be inflation. Right now, they're still making a pretty good argument, a lot of them, for deflation. Until that consensus comes in, then we're going to see them dump. The deflationists, we're going to see them dump what they've been holding, which is mostly in the dollar. In fact, I think it's going to be at a certain point when that consensus occurred. I think occurs. I think that, and the confidence is lost. I think it's going to be a quick reaction, and I think they're going to be trapped in dollars, and they're going to be absolutely panicking to get out at a certain point. Probably to try to time that. Try to give you guys a timeline for that. I think it's going to be sometime in 2022 that happens. Maybe in the first quarter or second quarter of 2022 is when confidence is going to be lost in the dollar. And I'm just hoping that that panic out of the dollar, and they're trying to get into hard assets and hard money, doesn't come too quickly. Because if it comes too quickly, if it's too big of panic, it could cause tremendous upheaval, because it's tremendous amounts of money moving from one asset class to another, and let's hope it's spread out over a whole year or 2 years, and that way we won't see so much disruption. If it comes in a month or two, and it's all done in a month or two, then that's when we could see the system shut down. Maybe a partial shutdown. And a system shutdown is not pretty, because what happens is basically infrastructure collapses, and that would be an untold loss of human life in a situation like that. It could cause tremendous problems, Anyway, listen, thank you guys for listening to my show. Like and subscribe. And we'll catch you guys in the very next episode. Bye-bye.